Thank you again for clicking on this video and embarking on another enlightening journey with us. Your support fuels our passion to bring you the most valuable financial insights. Let's dive right in. Welcome to Money Value Academy, where your financial journey transforms into a masterclass. Dive deep with us into the intricate world of money as we unravel mysteries and strategies that can elevate your financial wisdom. Buckle up and stay tuned, because today's topic promises to be an enlightening ride through the currency cosmos. You've likely heard of Andrew Jackson's potent declaration: "If the masses truly comprehended the sheer injustice of our monetary and banking structures, there would be uproar by daybreak." But what did he truly mean? And how has the landscape of our banking system changed over time, especially since the inception of the Federal Reserve? It's surprising, isn't it? The core essence of finance that impacts our lives daily remains a mystery to many. How is money made? What's the secret recipe behind the operations of the Federal Reserve? Let's embark on this enlightening journey to uncover these financial secrets, ones that could potentially reshape your understanding of wealth. Ready? Let's get into it. But before we dive in, a gentle reminder: if you find value in this content, don't forget to subscribe to the Money Value Academy for more such insights. The enigma of modern money. When you think about money, what comes to mind? Bills? Coins? For many of us, money symbolizes hard work and success. However, few understand its true origin. Why is a mere piece of paper accepted universally as a store of value? Most intriguingly, if you and I aren't printing it, then who is? Contrary to popular belief, it's not directly the government that's bringing this cash into circulation. Yes, they utilize it, but they're also borrowers, much like us. Historically, tangible assets like gold and silver represented money. If you needed funds, you'd either earn these precious metals or borrow them. The modern financial system has, however, taken a different route. Today, when the government needs funds, it sources them from the Federal Reserve. But where does this money come from? Well, the Reserve creates it. From here, the money is used to develop infrastructure, and through various transactions, it circulates, forming the backbone of our economy. But there's a catch. The Digital Mirage, approximately 95% of the money in our economy, isn't physical cash. It exists as numbers on computer screens. When you park your money in a bank, they don't just lock it in a vault, they lend it out. But what's fascinating is that even when they do, your bank balance remains unaffected. Here's how it works. If you deposit $100, the bank can lend $90 of it to others. Yet, they'll still reflect your full $100 balance. This loaned amount then finds its way to other banks and is further lent out. This cycle magnifies the initial amount, transforming it exponentially. It's like magic, except it's all in the numbers. The inherent flaw: the original money, sourced from the Federal Reserve, was credited as a loan, with interest. This means that there's always more owed than the money in circulation. It's a system that's forever bound in debt. The puppet masters: who controls the Federal Reserve? Tracing the roots of the Federal Reserve takes us back to a tumultuous period in American history. The late 19th century was a time of economic chaos. Following a series of bank crashes, the U.S. recognized the need for a central bank. After intense negotiations among the country's elites at Georgia's Jekyll Island, the Federal Reserve came into being in 1913. Comprising 12 banks, this isn't a monolithic entity, but a network. And who owns these banks? Essentially, they're owned by other banks in the country. This might sound like the fox guarding the henhouse, but remember, most major banks are public entities. So, indirectly, as shareholders, the public has a stake in the Federal Reserve. Navigating the banking labyrinth. It's crucial to remember that banks aren't financial guardians or altruistic entities. Their primary objective? Profit. Their strategies and offerings often benefit their bottom line more than they benefit you. Don't be swayed by polished words or glossy brochures. Further, banks have a soft spot for the affluent. The rich often get preferential treatment with lower fees and better interest rates. Ironically, those who need financial relief the most are often the ones charged the highest rates. Lastly, banks should not be your investment platforms. Their low interest rates are hardly lucrative. Instead of stashing your money there, consider investing in tangible assets or even in the stocks of these banks for potentially better returns. Understanding the interest game. You might wonder, if the Federal Reserve lends money to the government, who sets the interest rate? The answer lies in the Federal Open Market Committee, FOMC. This group meets several times a year to determine the federal funds rate, influencing how much interest banks pay when they borrow from each other overnight. This rate has a domino effect. When the FOMC increases the rate, borrowing becomes expensive, potentially slowing economic growth. Conversely, lowering the rate can spur economic activity, but there's more at play. Ever heard of inflation? Simply put, it's the rate at which the general level of prices for goods and services rise, causing purchasing power to fall. Ideally, inflation should be positive but controlled. Too much can erode your savings, while too little could indicate a stagnating economy. The FOMC uses interest rates as a tool to control inflation, ensuring the economy doesn't overheat or stall. The international impact. The US dollar isn't just a domestic currency. It's a global powerhouse, often used in international trade. Countries hold vast amounts of US dollars in their foreign exchange reserves. Consequently, the policies of the Federal Reserve have global implications. When the US dollar strengthens, commodities like oil, which are priced in dollars, become more expensive for countries with weaker currencies. This can lead to increased costs for these countries, impacting their economic stability. Conversely, a weaker dollar can boost U.S. exports, making products cheaper for international buyers. The illusion of savings accounts. Now let's address a common misconception. We're often told to save, to put our money in savings accounts. But is this truly the best strategy? When you factor in inflation, the interest rates offered by most savings accounts are abysmal. If inflation runs at 2% and your savings account offers 1%, in real terms, you're losing purchasing power. Essentially, the money you saved is worth less in the future. This isn't to dissuade you from saving. Emergency funds are crucial, but for long-term wealth accumulation, diversification is essential. Consider investments that historically outpace inflation, like stocks or real estate. Banks and financial crisis. Banks, though critical for modern economies, have played their part in financial crises. The 2008 crisis serves as a stark reminder. Triggered by a housing bubble and risky financial products, this crisis saw many banks on the verge of collapse. Post-crisis, regulations tightened. Banks were mandated to maintain higher capital reserves, ensuring they could absorb losses and prevent another meltdown. It's a testament to the interwoven nature of our financial system that the actions of a few entities could bring global markets to their knees. Crypto, the new frontier. In our journey to understand money, we can't ignore the rising titan, cryptocurrencies. Decentralized digital assets like Bitcoin challenge traditional financial norms. They're not issued by a central authority and promise transparency and reduced transaction fees. However, cryptocurrencies come with their risks. Their value can be wildly volatile, but their emergence prompts crucial questions about the future of money. Will decentralized finance, DeFi, render traditional banks obsolete? Only time will tell. In the grand tapestry of finance, it's easy to feel lost. But remember, knowledge is power. Equip yourself, ask questions, and be wary of taking anything at face value. As you traverse the financial world, arm yourself with wisdom and discernment. If these insights resonated with you, give us a thumbs up and share this video with your friends and family. Together, let's foster a community that's not just wealthy in assets, but also in knowledge. Stay curious, stay informed, and we'll see you in the next episode at the Money Value Academy. As we wrap up this enlightening journey, here's a small takeaway. Stay informed and always quest for knowledge. If this video added value to your financial perspective, consider liking and subscribing to Money Value Academy. It's a small click for you, but it means the world to us. Until next time, stay financially savvy.